Hi, it's Neil Frankel with WealthPilgrim.com. Today we're going to spend about 3 minutes and I'm going to explain to you, we're going to discuss all you need to know about FICO credit scores. They're very important, as you'll see in just a moment. Now, before we dive in, just to let you know, I really do look forward to connecting with you. It means a lot. I learned a lot from getting your questions or comments. I do, so please let me hear from you. You can connect with me either on my blog at wealthpilgrim.com or on Facebook, also Wealth Pilgrim, or on Twitter at Neil Frankel. No spaces. Okay, let's dive right in. 90% of the banks throughout the United States use FICO credit scores, and a 100-point difference in your credit score can make a huge difference in the amount of money you pay for your credit. If you have a lower score, you'll pay higher interest on your credit cards if you have credit card debt, which I hope you don't. And you'll certainly pay a higher mortgage rate when you take out a mortgage to buy a home. As a matter of fact, a 100-point difference can mean over a 30-year loan, $40,000 in extra interest that you'll pay, or more. That's with today's low interest rates. With higher interest rates, the differences are much greater and it could make a huge difference. So, very important to keep your score as high as possible. Now, what is a good FICO credit score? Well, the median score in the United States is 723. Okay? And what that means is that half of the people have less than 723 and half have higher. Now, what does that score mean? Does this mean you're a good person or a bad person? It doesn't have anything to do with it. But here's what the stores and the lenders and the financial companies look at when they see your score. It refers back to the likelihood of you defaulting on a loan. So, for example, if you have a score between 750 and 799, there's only a 2% chance that you're going to be delinquent in making a payment. So credit card companies love you, financial institutions love you, banks, everybody just loves you if you've got a high credit score because they know they're going to get the money that you owe them. On the other hand, if you have a very low credit score, you can see on this chart, you can see that as your credit score goes down, for example, if you have, 500, and only 5% of the people have a 500 score, but if you do, there's a 71% chance that you're not going to pay your bill. So you're going to either get very little credit, or if you do, it's going to be very expensive. So what you can take away from that is two things. Number one, you want to monitor your credit score to make sure that nothing's going on that you don't know about, okay? Because oftentimes there's mistakes. So that's the second point. If there's a mistake in your credit report, you want to fix it. And on my blog at wealthpilgrim.com, I'll show you exactly how to monitor your credit score for free without signing up for free trials. All you got to do is go over to my site and in the search bar, look for free credit report, no credit card required. And I'll show you exactly how to do that. And also, if you want to fix your credit, once you find out what your credit score is, if you see there's a mistake, you can get a free report. And once you do, if there's a mistake, I'll show you exactly what you need to do to fix that mistake. So I strongly encourage you, number one, to find out what your credit score is. Number two, to monitor it. Very, very important, and obviously fix any mistakes that come up. Okay. So again, I'm Neil Frankel at wealthpilgrim.com. Today we learned about the importance of the FICO credit score and what to do about it and what it means. For more great ideas on how to have no money worries no matter what, come on over to wealthpilgrim.com, sign up for your free weekly updates, and get a free e-course on how to make better investments.